Hey there, TRASTRA fans. So I guess all the Trump's idiotic ideas like handing them a little crypto check to pay off $35 trillion of the US sovereign debt, or creating a strategic national Bitcoin reserve paid off. And we've hit an all-time high with Bitcoin at 90, I guess, by now. Now that's amazing. But if you're watching this, you're probably wondering, is it time for me to cash out? And if it is, how do I do it? Well, welcome to episode 133 of your beloved TRASTRA Newsreel. So, will there be enough cash to cash out everybody? Doubtful. We've been here before, and you should get ready to incur some losses because when Bitcoin spikes, there's a mad rush as everyone thinks, time to cash out, time to cash out. But here's the thing, for all of us to sell and get real dollars or whatever, euros, whatever currency you're using, there needs to be enough liquidity in the market. Liquidity just means there's enough money on the other side, ready to buy your Bitcoin at a fair price. And if everyone wants to cash out simultaneously, well, things can get a bit tight. You may recall crypto platforms like Celsius, Voyager, and FTX, you may recall that one, which imposed strict withdrawal limits or froze withdrawals altogether during their liquidity crises in 2022. This happened because these platforms couldn't cover the high volume of redemptions after they made riskier investment decisions that backfired. A quick reminder, in late May, early June 2022, when Celsius had over $12 billion under management, Bitcoin was in mid-30s, probably lower 30s and mid-30s. And by the time the company filed for bankruptcy on June 11th, it was 26-ish, only to end the year at 16. Just imagine the size of cash reserves Coinbase, for example, and the rest of them must have to accommodate a run at $100,000 per coin. That's gonna be brutal. There were even legal cases where cryptocurrency exchange users sued the platform for losses incurred due to withdrawal freeze during significant market movements. One notable instance involves the exchange OKX in October 2020, when OKX temporarily suspended withdrawals, leading to a sharp decline in Bitcoin price, dropping approximately 3% within 30 minutes. This all is to say that exchanges and liquidity providers might have to make adjustments if they need to cash out a lot of people at the same time, and the cost of those adjustments is going to be passed on to you. Don't kid yourself about that. They might widen the price spread to protect themselves from big price swings, meaning you might sell at a slightly lower rate than you expect, or they might slow down transactions, which could mean waiting longer to get your money. The bottom line is that you need to be ready for that. Right, so who's got the cash to buy your Bitcoin? Now, you might be wondering, where's all that cash coming from? Good question. If the sell-off is huge, and it's going to be monumental, you better believe it, at least on the retail side, those reserves can run low, especially if banks aren't eager to back these trades. For example, Coinbase has a policy where it does not lend out customer funds without express permission, implying it maintains sufficient reserves to handle withdrawals, apparently. This was mentioned in discussions around the necessity of proving reserves post-FTX collapse, indicating that Coinbase maintains enough liquidity to avoid a bank run scenario. Binance is also committed to publishing proof of reserves, showing it reserves user deposits, but then again, we still remember the Washington Mutual, for example, the scandal in 2008, and it was an FDIC-insured bank, a huge one at that, and it spun customers' deposits and ended up being the largest bank failure in the US. For more recent history, recall First Republic Bank and Silicon Valley Bank, both in 2023, both FDIC-insured, and both failed more or less because of playing fast and loose with customers' deposits and risky cryptocurrency bets. So if seemingly respectable banks are committing some of the most blatant cases of outright fraud, well, you can safely assume that it's unlikely that the moral scruples of cryptocurrency exchanges are much stronger. Anyway, so where else could the money be coming from? Well, the most likely scenario is stablecoins. People convert Bitcoin to stablecoins like USDT or USDC, which are supposedly pegged to the US dollar. You can then store those stablecoins in a wallet like TRASTRA and cash them out whenever you need some hard cash in your pocket. I'd say it's going to be a popular option, probably most popular option, and Tether on October 29th minted 1 billion additional USDT on the Tron network, specifically for the purpose to make sure that retail investors and day traders have enough USDT whenever bull run ends. Additionally, Tether also wants to issue USDT on a new smart contract layer above Bitcoin, which clearly means that
In a world where intermediaries are sorely despised and the banner of financial freedom is flying high,
Tether wants to be, that middleman that we all apparently need carrying our Bitcoins from exchanges to banks. So here are a few more points and tips you might want to consider in preparation for the upcoming bank run. And again, don't kid yourself, this thing is going to happen. Bitcoin's probably going to go up to 100 or so before, retail investors rush to the bank teller window. So just get ready for that. All right, so there's slippage. Imagine you're set a price you want to sell at, but when you go to sell, you're actually getting less because the demand to buy has dropped. We already discussed that. This price drop, known as slippage, happens when the market is crowded with sellers. Selling in smaller amounts or being patient to avoid high traffic times can help reduce slippage and keep more cash in your pocket. Here's another thing. Sometimes, even if we're all ready to sell, the banks or institutions that support these exchanges might hesitate. Regulations around crypto are still changing, and if things get too uncertain, banks might pull back their support for exchanges. This could mean limits on cashing out, delays, or even higher fees, so it's just smart to stay updated on what's happening with crypto regulations, especially now that the game is getting really interesting. So we've covered all that before. Here's the bottom line. You have to stagger your sales to cash out from a big high. Just stagger yourself, slow it down. Selling a bit at a time rather than all at once keeps you avoiding big price drops, fees, and delays. And keep an eye on the market. If it seems everyone's trying to sell, maybe hold off for a bit until things settle. In the end, this 90,000, 95,000 Bitcoin high is exciting, but turning that number into actual dollars and euros in your account takes a bit of planning. It's not going to be easy, and you have to plan ahead. So by watching the market, understanding liquidity, and being mindful of the challenges we talked about, you can make the most of your investment. With that, thank you so much for watching. We're not going to go further into the news, although there's plenty going on in the cryptoverse right now. It's really booming, but we'll save all that for the next video. In the meantime, thank you so much for watching this one. Be sure to subscribe to our YouTube channel, join our Telegram community, and I will see you in the next video. Peace.